So the S&P performing well today thanks to gains in the information technology and utilities sectors. But my next guest is arguing that bullish investors are overly optimistic about wealthy households' ability to sustain the U.S. economy. Let's go to Doug Peta, Chief U.S. Investment Strategist at BCA Research. Thanks for joining us today.
Thank you, Marilla.
Can I start with the labor data, which hasn't been released in the U.S. because of the government shutdown? What are the hypotheticals floating around on what that data could look like?
It appears that the softness that we saw from May through August likely continued in September. Now, no one is hanging their hat on exactly what the ADP survey says. It is often comically far off from the official non-farm payrolls number, but the ADP number did suggest that payrolls contracted in September. We don't think that happened, but we do think you see a continuation of the really soggy, say, 25,000, 30,000 new payrolls that has been the average since May.
Okay, so you have pointed to what is a K-shaped economy. Can you explain around that?
Sure. So I do think this is a really apt metaphor. When you think about a capital K, there's one leg that's going up, there's one leg that's going down. And that seems to describe pretty well what we are seeing among consumers in the United States. So there really is a bifurcation among households where you've got the wealthiest households that are, things are going well, that leg of the K is pointed straight up and to the right. However, there's an increasing share of households that could fit into the bottom leg of the K, and that leg is declining. What we have seen since the long half-life of the incredibly generous fiscal transfers from Congress to households to try to combat the pandemic across 2020 and 2021, as that half-life dissipates, as that tailwind from those transfers finally ceases, households in the main are much more dependent on the labor market, or much more dependent on their compensation. And yet, payrolls growth has slowed to a crawl, and income growth has cooled off a good bit, such that looking out a year, it seems that we really shouldn't expect any positive real income growth, any income growth after inflation. So you've got an increasingly sizable lower leg of the K that is struggling, and a small minority of households that are in that upper leg that are doing real well.
Okay, but that being said, that can't really last with the wealthier carrying the economy?
We don't think so. If we can trust the Little Orphan Annie cartoons, Daddy Warbucks was doing quite well in the early 30s, and yet we still experienced the Great Depression. We have always had wealthy households, but we haven't had an episode in the past where wealthy households, being inured from the overall weakness in the economy, have been able to suspend the business cycle and keep us from having recessions. So I think that this idea that, hey, as long as stocks keep going up, wealthy households will get wealthier and they'll keep spending, I think that's a little misplaced.
Okay, are you then closely watching consumer spending habits?
We most certainly are. And that is where we would look to see confirmation of the weakness in the labor market. In our view, the labor market has been flirting with stall speed, the rate at which an airplane falls out of the sky if it doesn't maintain that speed. The labor market's been flirting with stall speed ever since May. And it looked before the second revision of the second quarter GDP estimates that consumption in the first half had also been flirting with stall speed. However, the consumption data were revised much higher in this last revision that came at the end of September. So I don't think it's fair to say anymore that the consumer was flirting with stall speed in the first half. We saw a real slowdown in the first quarter and sort of in the beginning of the second quarter, and say April and into mid-May, but things did seem to turn around. So look, we think the consumer is the next shoe to drop, but it hasn't dropped yet. We do expect, if the labor market continues to be really weak if there continues to be no hiring impulse whatsoever, that we will see consumption start to flag in a meaningful way, but we just haven't seen that yet.
And Doug, quickly, how fast or slow will the lower lending rates work to stimulate the economy?
It will work, but we know that monetary policy works with a lag. Milton Friedman told us that 50, 60 years ago, and that still applies. So, yeah, it's great that the Fed is going to be cutting rates, but I wouldn't expect that we will be able to really perceive a difference in activity in the economy until, middle of 2026 at the earliest, but more likely into the third or fourth quarter.
All right, we will leave it there. Doug Peta is the chief U.S. investment strategist at BCA Research. Thanks for joining us today.